So now that we described the two types of entry, the confirmation and the double confirmation entry, you might be wondering, where do I look to trade from, the extreme or decisional? We discussed a other situation for both the double confirmation and confirmation entry, but I'm a little confused. Let's talk about that. So after establishing whether to use a double confirmation or confirmation entry, the next step is to determine which level to enter on. There are two different level stances on the extreme levels of the decisional level when deciding whether to enter on the extreme level or decisional level. The biggest factor is where liquidity has been built and swept into relation to both of those levels. Having on focus on liquidity interaction will provide further context what we can use to select an entry area. There is no definitive conclusion on whether or not to use one level over the other, but these criteria provide us with a strong confluences and guidelines to approach an entry at either the extreme or decisional levels. Also, this emphasize and focus on a repeatable process in what's going to help us make our trading simplified. So let's first talk about extreme entries. Extreme level can be used to enter the market in two ways. In neither the extreme or the decisional level, sweep liquidity off and the stream sweeps liquidity, but non-decisional levels exist within that structural leg if no liquidity has been taken. The best area to look for an entry will be the extreme because decisional levels will likely be used as the liquidity. So extreme level will always be the best place to enter at the best place possible price to enter with the structural range. However, price doesn't always return to it. So let's take a look at extreme entries, and there's be two different types that we'll be referring to: the reversal extreme entry and a continuation extreme entry. And this will just factor in whether we are trading with the trend or we are starting to trade against the trend, or if the trend is potentially switching. So if we take a look at this first example, we can see that no liquidity has been taken by the extreme. So the zone is swept and trapped from. So there we can see the price criteria: a low V trade, higher creating a changing character. We start to see the last point of supply fail creates our tradable zone, and the price trades down if we swap or just trade slightly below the zone itself, and then trade higher. And if this case, because the extreme didn't take liquidity, the extreme itself was used the liquidity. Another example that we can take a look at is a supply demand zone flip, or in this case, a decisional level is created so as we can see price trades lower. So we trade into the last point of supply price, create that initial reaction, the extreme of the reaction leg, the failure of that zone, and we create a supply demand zone flip, which creates structural and reactionally liquidity price and trades lower. So sweeping that flip, taking the liquidity and trading into the extreme. If we take the flip side just to take a look at supply of selling situation, we can see that we create the high, we start to break the last point of demand. Trade lower, creating that change of character and the potential shift in order flow. The extreme has not taken liquidity. Therefore, the extreme could very well likely be taken as liquidity, and also see the extreme hold and trade lower. Another example where the decisional becomes the liquidity, we can see that the extreme has not taken liquidity and we have pressed. Creating a high, we trade down into the last point of demand, gives a reaction of our initial reaction. So our extreme or the reaction lag, and the failure we've seen, the last point of demand fail. We anticipating that because the extreme has not taken liquidity, the decisional or this demand to supply flip zone will be in fact used as liquidity to trade into the extreme. Enter that trade lower now, and things to note here's that while we have an entry zone maker at each of these extreme zones, this methodology and this way of thinking can also be applied to double confirmation entries for your first level of respect zone as well. So now it's pivot into continuation entries just to take a look at the market. Continuing on now, if we have to look at this continuation example, we can see that the extreme takes liquidity and no decisional is present. So as we can see, we create this bit of structural liquidity price. These internal lights hits breaking highs that we trade down below them, sweeping the liquidity and then trading to the upside, causing that test last point of supply to fail and price to continue market a higher high. We now have a tradable demand level at the extreme that has taken liquidity. Another example would be the supply to demand zone flip doesn't sweep liquidity, therefore is more likely to be used as a structural liquidity. So just put simply, simplify. So Decisional is used as liquidity. We can see that price is creating as a high-low creates. Our last point of supply at supply level price trades into that supply level initial reaction extreme or the reaction like the failure. We've seen the last point of supply failure and supply to demand zone level created. So trades lower sweeping the flip or sweeping the structural liquidity or the decisional level trading into the extreme to the then trade higher. Now the final example that we can take a look at. If the supply demand don't flip, decisional level doesn't sweep liquidity, and therefore it's more than likely used to be swept as a structural liquidity, and the extreme is also part of demand chain. So we can see is price creates a higher high, price trades back into demand. So price then trades high reacting of or the last point of supply, initial reaction extreme, or the reaction like the failure of the last point of supply. Since the extreme has not taken liquidity, we can guide that the decisional is likely to be swept and used as liquidity to trade into the extreme demand zone and a trade higher. And that you notice if we've been going through these, we have also been using our point selection and confluences to straighten the zone that we're talking about, whether we have liquidity points of interest and extremes. We had demand chains and extreme levels of demand to trade from the using all of these trades and things in conjunction is going to create higher probability points of interest, especially when we pair them with confirmation. So double confirmation entries and knowing whether to trade from the extreme or the decisional levels. Now let's just take a quick look at the supply level continuation entries, and similarly we can see that the extreme takes liquidity and no decisional is present within the leg. So we would trade the extreme, so we can see as we start to create lower lows and then trade higher, taking the liquidity above this high, and then we trade lower, causing the last point of demand to fail, pointing in a new lower low, creating our supply low level. Now whether it's first level of respect supply level of a table supply level will again depend on whether or not you are looking at confirmation or double confirmation entry. Another example, the demand supply flip zone of decisional level does not sweep any liquidity, and therefore is more than likely used as a structural liquidity. And as we can see, price creates a demand level to create our pullback. So we trade lower into the last point of demand, get our initial reaction. Our extreme of the reaction leg, the zone fails, our last point demands fails, and then price trades up, taking the flip or the decisional level as liquidity because the extreme hasn't taken liquidity taps into the level of supply and then continues to trade lower. And the final example is the demand supply flips on or the decisional level doesn't sweep liquidity and therefore is more than likely to be used as a structural liquidity. And also because the extreme has no swap liquidity, the extreme is also part of a supply chain. So as we can see, we create a supply level, we trade lower price run into supply, we trade lower, we interact with the last point of demand, creating our initial reaction, our extreme of the reaction leg and the failure because the extreme has not taken any liquidity. We're anticipating that the decisional level, this demand to supply flip will be used as the liquidity for price to trade into the extreme and trade lower. So this point has higher quality because it is part of supply chain as well as trading from the extreme. So now let's dive into decisional entries. A decisional level can be used to enter the market in two ways. In the extreme sweeps, liquidity of the decisional level itself sweeps liquidity. In these situations, the decisional level can be focused on because liquidity has been factored into the setup and should fill the move. In the market, even if all the criteria are met, the market may still go back to the extreme level and ignore the decisional level. The market can still use the decisional level as additional liquidity to fuel the move, as there may have not been enough liquidity swept in the market to properly fuel the move. Now let's take a look at the two different examples of types of decision entries, the reversal entries and the continuous entries. And as we can see, if it's draw this on a little bit more, and please, like we have bearish trend likely interacting with a higher time frame level of demand, and what we can see is we create our lower low price trades into the last point of supplies. If prices to continue trading lower, we would see the price so react of supply and continue to trade lower, but because we have interact with a higher time frame level of demand, price reacts of our last point of supply, our initial reaction, our extreme of the reaction leg, and the failure we can then see after the last point of supply has failed. So price trades lower than the previous reactionary structural liquidity flip area and then continues to trade higher. So the supply to demand zone flip builds and swap structural liquidity. Therefore, we can look at the trade, the decisional flip level. Another example that we can look at the price trades. Lower we react of the higher time frame point of demand price trades into level of supply trades, lower takes out the initial reaction and then trade lower. This would be a reactionary swipe, and that we can see the price that trades higher. Seeing the last point of supply fail, this is a key point to form our actual demand zone that we would be looking to trade from, but because their reactionary portion of the supply zone has been swept, it has criteria a tradable zone to the decisional level. So now let's take a look at supply situations based on reversal entire at the decisional zone, and that we can see the price creating higher high and higher lows, and it's trading into a higher time frame level of supply. So when price interacts with this higher time frame the level of supply, we see a reaction trading into the last point of demand. This last point of demand gives a reaction, our initial reaction, our extreme or the reaction leg, and the failure we have now seen the last point of demand fail. So we're starting to see order flow shift price that trades higher above the previous swing, higher of the extreme of the reaction leg, and then trades lower than we can see from that is that price taking the structural liquidity that was created from the extreme of the reaction leg and created a tradable supply level. And because this extreme of reaction leg was swept as liquidity, we are able to trade from the decisional level as it has swept liquidity. Another example is we have price interacting with the level of high time frame supply. We come down into the last point of demand. Give a reaction, the initial reaction, the extreme of the reaction, let's see the failure of the initial reaction and the price trades higher, sweeping the extreme of the reaction leg and then trading lower. So causing the last point of demand to fail. The key thing to note beside the fact that we swipe liquidity is also that the last point of demand has actually failed. Once this last point of demand has failed, it creates our tradable zone. We're able to trade from the decision level because we took the extreme of the reaction leg and use it as liquidity. So the decisional hasn't taken effect liquidity now. So it took and continuation entries using a decisional level, and continuation entry would be as you would expect price. So forms a low, forms a lower high, forms a lower low, and then price trades above. So the extreme has taken the liquidity and has now trades into the last point of demand given an initial reaction. So the extreme of the reaction leg and then the failure of that last point of demand, because the extreme has taken liquidity, we are able to trade from the decisional level, which is a supply to demand zone flip. And another example that we can use in the extreme takes liquidity and forms a supply chain. So as we can see, price is in a bearish. We are creating lower lows and lower highs. Price creates our lows, lower price trades higher, taking out the previous lower high swept. Its liquidity trades down into the last point of demand. Price then trades into the previous supply that was in the otherwise higher high. They swap here, and the key here is now we see the last point of demand fail. We need to see this last point of demand fail, confirm that this in fact was a swept, and now that we've seen price trade lower and break the last point of demand, we can trade this more decisional level. So the reason it would be considered at the decisional level is because the extreme would still be present in this portional, as if we were looking at our market structure, we were abusing this previous higher low and this lower low as our structural range, and because the extreme liquidity were able to trade from the decisional level. Now let's take a look at the flip side and looking at demand entries at decisional levels for continuational entries and similarity. We're seeing the market putting a higher high and higher lows. So in a bullish trend, so we form a high, we form a higher low, we form a higher high, price then comes, sweeps below the previous high low, and then trades up into the last points of supply, gives an initial reaction and extreme of the reaction leg and causes the last points of supply to fail. A key here in that the last point of supply fails. Now we can gain that the extreme has swept, structural liquidity, and we able to trade from this supply to demand zone, flip decisional level, and then a final example similarity. We have a bullish example that we are trending. So making higher highs and higher lows price, creating higher highs, we pull back, taking out their previous higher lows, sweeping below with price, then trades higher, trading into their last point of supply, gives a reaction. This reaction trades and to the extreme, which causes the last point of supply to truly fail, forming our higher high again. This is an important key things to note here, that our last point of supply has in fact failed to confirm that this was true. A sweep of structural liquidity, and because of this and the fact that the extreme has taken liquidity, we are able to trade from a decisional level. And again, this is a decisional level because if we are looking at a bullish structural range, we will be using this higher low and this higher high to warrant our structural range for this bullish situation. And as you can see, this is a very powerful lesson in understanding whether to trade from the extreme or the decisional level. All this situation can be used then you're looking at confirmation entries in terms of whether you wanted to take your trade from an extreme or decisional level, and we can also use this information on a double confirmation entry to establish our first level of respect, because the first level of respect can also format an extreme or decisional level based on these confluences, and on top that we can use this information. So gauge whether or not you're actually going to enter our double confirmation entry on an extreme or decisional level, because if you're looking at our double confirmation entry, your flow component of the double confirmation could be at the an extreme or a decisional level. So let's use an extreme level for an example. If we establish our first level of respect, and then we're looking at our tradable zone of execution zone on that double confirmation entry. It can be on an extreme of the decisional level, so we could see a first level respect on extreme zone and execute based on a decisional level. So these things are very important to take note of and implement into your trading.